Hi there, I'm John Stevenson, the Guaranteed Retirement Guy. Today we're going to be talking about annuities and if they are safe in a recession. All right, so if you've lived long enough, you've probably lived through several recessions and you are worried about the next one, okay? And you're worried about maybe an annuity that you own and you're worried about a recession maybe taking some of it away from you, okay? Well, let's talk about that. So with variable annuities, they are tied to the stock market. So if you have a variable annuity, then yes, if there is a recession, you're going to lose some money most likely in that annuity contract value, okay? Because they're tied to sub-accounts, mutual funds, and when the stock market drops, these funds usually drop. And when they do, you're going to see a significant decline in that variable annuity. Now, any other type of annuity like a fixed or a fixed index annuity, they absolutely are not. When you're talking about stock market crashes, they are not affected by that stock market crash. Okay, so when you had the dot-com crash, or when you had the housing crash and the recession after that in 2008, okay, people that had fixed annuities or fixed index annuities, they were not affected. Okay, they didn't lose a dime of their money because it was not actually invested in the stock market. And this can be very confusing because a lot of people will reach out and they're like, well, how can I get the growth of an index like the S&P index and then not have any losses? Like, how does that work? That sounds too good to be true. How can the insurance company do that? Well, it's really, really simple, really, with options. And you're probably familiar with options, or there's quite a few different types of options, okay? But the ones I want to talk about are the options that you purchase associated with an index or maybe a stock. And you can do the same thing with real estate, but right now we're talking about annuities. So what do these insurance companies do with an indexed annuity? Well, if you purchase an indexed annuity, okay, you've got your money sitting in there, and let's say you tie it to the S&P index, okay? And maybe they're giving you a cap of 10%. A cap just means they're limiting the amount that you can earn with that index during that point-to-point period. Point-to-point means if you purchase it in July, then it's going to be 12 months. It's measuring from that July to the next July, if it's a one-year point-to-point. Okay, that's very, in its simplest terms, that's what they're measuring. They're measuring that 12-month period, and if the index went up, they're going to measure whatever that index did during that period, and they're going to credit it to your account. Now, if it happens to earn more than 10%, let's say it earns 12%, then they're still going to only credit your account 10%. Now, in return for that, when the market is down, when the market drops 30%, let's say 1 year, okay, what's going to happen to your account? Well, let's say the year before you earned 10%. So you got 100,000 in, but now you got 110,000 because you earned 10%. Okay, well, what happens the second year when the market's going down? Well, really nothing happens. At that point, your account just stays at 110,000, okay, and it waits for the next period, and it'll measure the index during that period. It's really that simple. And it's because the insurance company, they're not exercising the options, okay? They're buying these call options, and if the market is down, of course, they're not going to exercise it, okay? They're just going to let them expire worthless. Now, they do lose money, right? Because they purchased those options. They were hoping to exercise them. They were hoping that the market would go up and give them a profit. But there are years where it doesn't. And so when it doesn't, they can't exercise those options. And of course, they do lose the cost of the option, but since you were never in the index, you were never in the stock market, you didn't lose any money. Okay, because they never exercise that. And so that's how you retain your gains every year. And if you've got gains or you got compounding growth, then you're going to get that credited to your account, and that'll continue on. If you got a down year or a couple of down years, it's going to stay up here waiting for the next market upturn. Okay, that's really that simple. Now, the reason why they cap your gains is because if the index has 15%, they're going to take that difference. They're going to take that 5% on top of that 10, if your cap is at 10, and they're going to pocket that. That's how they profit. And of course, that's how they cover their costs for the years where the market is down and they cannot exercise those call options. Okay, so it's really that simple. With indexed annuities, that's what's happening. They're investing in these indexes, and that could be the S&P 500. Okay, it could be the Fidelity, Barclays. It could be BlackRock. Okay, there's so many indexes out there, and you can buy call options associated with these indexes. So that's how you get a return from these indexes, and of course, that is how you are 100% protected from any market downturn. So if there is a recession, okay, and the market is dropping through the floor, rest assured, if you got a fixed index annuity, you're fine. Okay, you're not going to lose any money. So they are designed for safety. And if you have an income rider is completely separate, and it will give you a ton of guaranteed income for the rest of your life. And it actually will usually give you a roll-up rate, sometimes as high as 8 to 10% every year, regardless of what the market conditions are, because it's for income. And that's a different video. That's a different topic. But I just wanted to really just hit home. If you're looking for guaranteed income, book a call. We'll talk about all of the top annuities, and I'll show everything that's available. Now, for fixed annuities, okay, MYGA contracts called multi-year guaranteed annuities. Those are different than fixed index, okay? They're not tied to an index. They just have a straight rate of return. They're really the annuities world version of CDs, okay, to make it as simple as possible. So if you're getting 5%, which right now they're paying 5%, and you compound that over 10 years, that's what you're going to get. So it's a very, very simple policy. What you see is what you get. If you're getting 5% compounded every year, that's what you're going to get, okay? So the downside is if the index, the market is going up like really, really hard, okay, you're still only going to get that 5%. You won't get the 10% that maybe the indexed annuity would have gave you. But on the flip side, when the market is dropping, when those indexed policyholders are earning nothing, they're not losing anything, but they're not making anything either, you're earning that 5%, okay? So there's trade-offs to both of them. If you're looking for highest income, though, the fixed index annuity with the income rider is the best option. Okay. All right. Hope that helps. If you want to look at annuity calculators, go to my website, johnstevenson.com. I provide the calculators there, and you can look at the highest payouts at your leisure. And then if you want to book a call with me, there's a link to book a call. You can either book a call right below this video, or you can go to my website and book a call. I'd be happy to help you. If you're looking to purchase an annuity, I'd love to help you. And of course, you just got questions, I'd love to help you with that as well. Okay. I'm not going to try to push you or sell you anything. Of course, if you're looking to purchase, I'd love to help you. But again, I hope this video has just given you some value, giving you hopefully some answers to your questions. If it has, I hope that you will like it. I hope you'll subscribe, hope you'll share, and I hope you'll comment. If you got questions, don't be shy. Ask them. I'll answer. And I'd love to help you with any of your annuity questions. All right. That's it for today. I really appreciate you watching, and we'll see you next time.